Welcome to Talk Tickers.
Thanks for having me back.
So you are joining a high-level financial analysis and CFA-aligned education session today. We are doing a deep dive into something that, frankly, I think way too many people just brush off as, another tedious, non-cash accounting compliance exercise.
Oh, absolutely. They see it as just paperwork.
Right. But if you actually understand the mechanics behind it, this concept is basically the ultimate corporate lie detector test. We're talking about goodwill impairment today.
Yes, we are. And it is a massive topic.
It really is. I mean, Imagine you're a company, right? You write a check for like $10 billion to acquire this high-flying tech competitor. You do the whole press tour. The CEO's out there touting these game-changing synergies. The stock pops and everybody's celebrating.
Champagne everywhere.
Exactly. But then say 2 years later, you realize the magic you bought is just completely worthless. The customer base is churning. The brilliant engineers you acquired have all packed up and quit, and the proprietary tech is already obsolete. So the question is, how does management hide that catastrophic failure from you, the investor?
Well, the short answer is eventually they can't. And that is exactly why we are analyzing this today. Goodwill impairment is essentially the financial system's built-in accountability mechanism.
Right. It forces the truth out.
Exactly. It forces the reality of a bad deal right onto the balance sheet. I mean, as an analyst or a portfolio manager, you spend an incredible amount of time evaluating the strategic rationale of a merger or acquisition on the front end. But goodwill impairment, that's the back-end scorecard.
Yeah, that's a great way to put it.
When that impairment charge finally hits the income statement, it's just this glaring neon sign to the market that management overpaid, miscalculated, or just fundamentally destroyed the value of what they bought. I mean, it wipes out equity, it shrinks the asset base, and it just completely wrecks net income.
It's basically the definitive moment the music stops on M&A exuberance.
Oh, 100%.
So look, if you are building financial models or you're preparing for a CFA exam or honestly just trying to understand why a company you follow just reported $1 billion surprise loss, this deep dive is for you.
Absolutely.
We are going to start with a summary of the core concept, like what goodwill actually is in the real transactional world. From there, we'll go in depth into the theory and practical application of the impairment testing process.
Which is strict.
Yeah.
Very strict.
Super strict. We'll walk through the the strict order of operations, the hierarchy of how assets are tested. We'll explore where the boundaries of these tests are drawn within massive corporate structures, compare the US GAAP rules with, international IFRS standards, and break down the specific real-world triggers that force a company to actually sound the alarm.
And we can't forget the math. We'll dig into the qualitative and quantitative tests, the brutal tax realities of these write-downs, and finally, a hidden trap waiting for private companies preparing for an IPO.
Yes, the IPO trap. That part is wild. But to really grasp the gravity of an impairment, I feel like we first need to strip away the jargon.
Let's do it.
Let's define goodwill in practical terms. Because when one company acquires another, they almost never pay just the book value of the target's net assets, right?
Almost never. I mean, if a target company has, say, $10 million in tangible assets, like warehouses, delivery trucks, cash, and maybe another $5 million in identifiable intangible assets, like a patented algorithm or a very specific customer list.
Right.
So the fair value of what you can actually point to, what you can identify, is $15 million. But the acquiring company, they might pay $50 million to buy them.
Right, so they are paying a $35 million premium above and beyond the fair value of every single identifiable asset.
Exactly.
And under purchase accounting rules, that $35 million residual plug has to go somewhere on the balance sheet just to make the accounting equation balance out.
Right. It can't just disappear into the ether.
No, it can't. That plug is goodwill.
Yeah.
But I think people get confused. What is it really? Because it's not just a balancing figure. Right?
No, not at all. It represents the non-physical, the hard to quantify drivers of future economic benefits. We are talking about things like a pristine brand reputation or a deep-seated customer loyalty or the synergistic value of a highly trained workforce.
Or even just the expectation of expanding into new untapped markets.
Exactly. It is essentially capitalized optimism.
Capitalized optimism. I love that phrase.
Right. Management is quantifying their expectation of excess future returns, and they are putting that optimism right on the balance sheet as an asset.
Wow. Okay, so now if you are an investor, you obviously want to know if that optimism was actually justified.
Which brings us to the core of our analysis today. how the accounting standards force management to rigorously stress test that capitalized optimism over time.
Right.
But here's the trick, and it's a foundational concept you just have to understand before you model anything. You cannot test goodwill in a vacuum.
Okay, why not?
Because goodwill is the ultimate residual asset. Its value is entirely dependent on the cash flows generated by a broader group of assets working together. You can't directly measure the fair value of goodwill on a standalone basis.
Because it's intangible.
Right. You can't just take customer loyalty or synergy, put it in a box, and sell it on the open market.
That makes perfect sense. So before a company can even begin to assess whether its goodwill is impaired, it has to look at the underlying foundation first. Let me introduce an analogy here because I think it makes the abstraction much more tangible for people.
Go for it.
Think of the business unit we are evaluating, like a newly purchased, fully furnished luxury house. And it's in a highly exclusive neighborhood.
Okay, I can picture that.
When you bought this property, you paid for the physical structure, you paid for the high-end appliances, but you also paid a massive multi-million-dollar premium just for the vibe.
Oh, for sure. The location premium.
Exactly. The prestige of the zip code, the incredible sunset views, the proximity to a private beach, that neighborhood premium, that is your goodwill.
I like where this is going.
Right. So now, a few years later, say a storm hits, the market shifts, and you want to assess if you drastically overpaid for that vibe.
Yeah.
The accounting rules say you cannot accurately appraise the value of the neighborhood prestige until you have accurately appraised the physical condition of the house itself.
Which makes perfect logical sense.
Right. Because if you walk into the house and the plumbing is completely destroyed, the foundation is cracked, and the roof is literally caving in.
That is a direct physical asset problem.
Exactly. That is not a neighborhood vibe problem. You have to write down the value of the roof and the plumbing first.
Right.
Only after you know the true current degraded value of the physical house can you figure out if the remaining value of the property justifies the premium you originally paid for the location.
That is a highly accurate structural analogy, and it perfectly illustrates why the financial accounting standards enforce a very strict chronological order of impairment testing.
They make you check the plumbing first.
They do. A firm must test its other, more tangible assets before it is legally allowed to touch goodwill. If you test the residual premium first, without fixing the roof and the plumbing, you will fundamentally misallocate the impairment loss.
You'll end up blaming the neighborhood for a broken pipe.
Exactly. So let's walk through the strict hierarchy. Because if you are an analyst tearing apart a 10K, watching this sequence unfold is like watching a motion train wreck.
It really is. Okay, let's do it. What is the very first asset class that management has to evaluate before they even think about goodwill?
The very first step hits working capital, specifically inventory. Under ASC 330, the rules dictate that inventory must be tested first.
Yeah.
Companies must assess their inventory at the lower of cost or market for those using LIFO or the retail inventory method, or the lower of cost or net realizable value for all other methods.
Hold on. Let me put this into a real-world scenario for the listener. Imagine you're covering a retail company, right? And they just acquired a trendy fast fashion brand. They paid a huge premium. Lots of goodwill.
Classic scenario.
But then a year later, consumer tastes shift dramatically. Suddenly, the warehouses are just full of neon apparel that absolutely nobody wants to buy.
It happens all the time.
So the company realizes they can't sell this inventory for anywhere near what it costs to manufacture it. They had to mark it down by like 70% just to clear the racks.
Exactly. That is a direct inventory impairment. The carrying value of that inventory drops immediately. They take the hit to the income statement through cost of goods sold.
But they still haven't touched goodwill yet.
No, not yet. Once the inventory is accurately stated at its newly depressed reality, the controller moves to the next step in the hierarchy: accounts receivable and contract assets.
Okay.
This involves recognizing expected credit losses, what is known as the CECL model, and evaluating deferred commission write-downs under ASC 310, 326, and 340-40.
Okay, so staying with our scenarios, let's pivot to a business-to-business enterprise software company.
Good example.
They acquire a smaller software vendor, again, paying a hefty goodwill premium. The acquired vendor had a massive accounts receivable balance because they had just signed a $100 million licensing deal with a major corporate client.
Nice revenue bump.
Right, but suddenly, that corporate client files for Chapter 11 bankruptcy.
Oh, brutal. If that client is in bankruptcy, the probability of collecting that $100 million drops to pennies on the dollar.
Instantly.
Right. So the software company must immediately recognize an expected credit loss. The receivables are impaired, and the carrying value of those assets on the balance sheet is slashed.
But again, we are still far away from testing goodwill.
Still miles away. The next phase in the order of operations forces the company to look at their investments. They must check for impairments in any debt or equity securities they hold.
Under ASC 320 and 321, right?
Exactly. For example, if they are holding debt securities with the intent to hold them to maturity, but a massive macroeconomic shift occurs, say, a sudden and aggressive sequence of interest rate hikes by the central bank.
Like we've seen recently.
Exactly like we've seen. The fair value of those older, low-yield bonds just plummets. They need to recognize current expected credit losses over the lifetime of those securities.
Okay, so we've checked the inventory, we've checked the money owed to us, and our investment portfolio. Basically, the house's short-term plumbing is inspected. What is next in the hierarchy?
Now we move to the heavier long-term assets. The next category encompasses property, plant, and equipment, as well as finite-lived intangible assets under ASC 360.
Okay.
This is a crucial step in the sequence. These assets are usually tested as an asset group.
What exactly defines an asset group?
An asset group is basically the lowest level for which identifiable cash flows are largely independent of the cash flows of other assets.
Let me stop you there, because the concept of finite-lived intangibles is super important for the listener to distinguish here.
Yes, it is.
We aren't talking about the eternal brand name yet. We're talking about intangible assets that have a definitive expiration date.
Precisely.
Things like a 5-year non-compete agreement, or a software patent that expires in 10 years, or a customer subscription list that naturally churns out over 3 years. These assets amortize. They steadily lose their recorded value over time, just like a piece of physical machinery depreciates.
That is exactly right. Both the physical factory and the software patent are tested together in this step. And the test here is initially for recoverability, which is based on undiscounted cash flows.
Undiscounted, that's a key word.
Extremely key. Management looks at the factory and the patent and asks, will the total undiscounted cash we expect to generate from using these assets over their remaining useful life exceed their current carrying amount on the balance sheet?
Got it.
If the sum of those expected future undiscounted cash flows is less than the carrying amount, it means the asset group is not recoverable. An impairment exists, and the asset group must be written down to its true fair value.
So imagine an auto manufacturer that bought an electric vehicle startup. They paid for the factory, the patented battery tech, and a massive mountain of goodwill.
Sounds familiar.
Right. But then a new competitor releases a solid-state battery that makes the startup's tech completely obsolete. Management runs the projections and realizes the factory and the old battery patents will never generate enough cash to justify what is on the balance sheet.
So they take the hit.
Right. They write down the PP&E, they write down the patents.
Right.
But amazingly, they still aren't allowed to test the goodwill yet.
They are getting closer, but there is one final hurdle. The penultimate step before goodwill is testing indefinite-lived intangibles under ASC 350-30.
Okay, what falls into that bucket?
These are powerful assets that do not amortize because there is no foreseeable end to their useful life. A prime example is a foundational trademark, a legacy brand name, or certain broadcast licenses.
Right.
Because these assets don't steadily amortize away over time, they must be tested for impairment by comparing their fair value directly to their carrying amount. If the legacy brand name has lost its luster with consumers, its fair value drops and an impairment is recorded.
Wow. Okay. So only after this entire grueling cascading sequence is complete inventory is written down, receivables are slashed, investments are marked to market, factories are impaired, patents are devalued, and trade names are degraded.
Does the company finally, at the very end of the line, test the goodwill?
That is wild.
Yes. The underlying assets must reflect reality before the residual premium can be judged. So, if you are an analyst listening to this, what is the core actionable takeaway?
What is it?
The actionable insight is that this hierarchy provides you with a predictive roadmap. An inventory write-down or a significant PP&E impairment is the ultimate canary in the coal mine.
I really want to emphasize this for everyone modeling out future earnings. If a company you cover suddenly announces a restructuring charge that includes a massive write-down of their manufacturing facilities, you should immediately be on high alert for a subsequent goodwill impairment.
Oh, without a doubt.
Why is it so guaranteed?
because the underlying cash flow generation of that business unit is severely compromised. The company just publicly admitted that the physical assets and the patents can't generate the cash they originally thought they would.
Right.
If the tangible foundation is crumbling, the carrying value of the overall reporting unit is under immense pressure. It means the residual premium, the goodwill, is almost certainly the next domino to fall, either in the current quarter or the next annual testing cycle. The cash flow assumptions that supported the original M&A premium have just completely evaporated.
That is a phenomenal connection for forecasting. If you see the house falling apart, the neighborhood vibe premium is mathematically doomed.
Exactly.
Which naturally leads us to ask, where exactly do we draw the property lines for these tests? We know what we are testing and the strict order we test it in, but we need to establish the perimeter.
The unit of account.
Yes, the unit of account. A crucial concept for you to understand is that goodwill is not tested at the consolidated overall corporate level under standard US GAAP. You don't just look at the whole Fortune 500 company as one big bucket.
No, you definitely do not. Under US GAAP, the impairment testing occurs at what is strictly defined as the reporting unit level. This perimeter is highly specific and it's heavily regulated.
Okay, so define a reporting unit for us.
A reporting unit is either an operating segment or one level below an operating segment, which the accounting rules technically refer to as a component. To truly understand where the impairment test happens, you have to understand segment reporting rules.
Right, and segment reporting is where the financial statements meet corporate reality. The rules lay out 3 distinct criteria for something to be considered an operating segment, right?
Yes, 3 criteria.
First, it has to engage in business activities from which it earns revenues and incurs expenses. This even includes intercompany revenues and expenses. So if a manufacturing division only sells parts to the assembly division, it still counts.
Exactly.
Second, its operating results must be regularly reviewed by the entity's chief operating decision maker, or KODM.
And let me clarify the CODM concept because it often confuses people.
Yeah, please do.
The CODM is not necessarily a single person with a specific title. It is a function.
Oh, interesting.
It could be the CEO, it could be the chief operating officer, or it could be an entire executive management committee. The key is that this function reviews the operating results to make decisions about how to allocate resources to the segment and to assess its performance.
Got it.
The third criterion is simply that discrete financial information must be available for it. So if a division has its own discrete profit and loss statement, and the executive team looks at that P&L to decide where to invest capital next quarter, that division is an operating segment.
Right.
And the reporting unit where goodwill is tested is either that exact segment or one level deeper into the organization.
But let me push back here with a practical modeling question, because this is where executives can get very, very creative.
Oh, they certainly try.
If I am looking at a sprawling, massive conglomerate, the kind of company that makes like a dozen acquisitions a year, how easily can management hide a terrible, value-destroying acquisition by simply blending it into a larger, historically highly profitable reporting unit?
That's the million-dollar question.
Right. Like if I buy a failing startup, can I just sweep it under the rug of my most successful division?
You are hitting on the exact tension inherent in defining the unit of account. This is where the aggressive accounting happens. And it's precisely why the segment aggregation rules are so heavily scrutinized by the SEC and by external auditors.
Because management absolutely wants to blend bad acquisitions into good ones.
Of course they do. But the rules stipulate that 2 or more components of an operating segment shall only be aggregated and deemed a single reporting unit if those components have similar economic characteristics.
Similar economic characteristics. That sounds like a loophole you could drive a truck through. I mean, how do auditors actually enforce that?
It is definitely a battleground. To determine if components are truly similar, auditors force management to evaluate highly specific factors. They look at the nature of the products or services. Are they selling enterprise software or consumer hardware?
Right.
They look at the nature of the production processes. They look at the type or class of customer are they selling to governments or retail shoppers. They examine the methods used to distribute their products, and they scrutinize the nature of the regulatory environment.
So if a highly profitable legacy software giant decides to try their luck and acquires a struggling, unprofitable consumer virtual reality startup, they can't just lump that VR startup's goodwill into their massively profitable enterprise cloud reporting unit.
Theoretically, no.
Even if the CEO really wants to bury the mistake.
The regulatory intent is to prevent exactly that. The Enterprise Cloud Division and the Consumer VR Hardware Division have different customers, different distribution methods, and entirely different economic characteristics. They must be kept as separate reporting units. However, if management successfully argues that an underperforming acquisition shares economic characteristics with a highly profitable existing business line, they can aggregate them. And if they do, the immense fair value of that broader profitable unit creates what we call a massive cushion.
Ah, the cushion. This is where the magic trick happens.
Yes, it is.
If the legacy division is worth $10 billion more than its carrying value, and you drop a failed $1 billion acquisition into that exact same bucket, the overall reporting unit is still worth $9 billion more than its carrying value.
Exactly.
The bad acquisition essentially hides in the aggregate math. The total fair value remains higher than the combined carrying amount, and zero goodwill impairment is recorded, even though that specific startup was a complete and utter disaster.
Precisely. The failure is completely absorbed by the success of the legacy business. This is a critical lesson for analysts. You must rigorously read the segment disclosures and the financial footnotes.
What should they be looking for?
If a company suddenly announces a strategic realignment, or restructures its reporting units, or changes its segment reporting immediately following a highly questionable premium acquisition, that is a glaring red flag.
Okay.
It frequently indicates an attempt to shuffle the organizational chart to blend away an impending goodwill impairment. You have to ask yourself, did the underlying economics of the business actually change, or did the controller just move the property lines to hide the broken plumbing?
That structural manipulation is a phenomenal dynamic to watch. Which brings us to a major pivot in our analysis today.
Right, into international territory.
Exactly. Since so many of you covering equities aren't just looking at U.S. domestics, but also international equities or cross-border M&A, we really have to contrast this US GAAP reporting unit approach with the International Financial Reporting Standards, specifically IAS 36.
You have to.
Because if you apply US rules to a European competitor, your model is going to be fundamentally broken.
The differences between US GAAP and IFRS are structural and profound, starting right at the unit of account we just discussed. Under IFRS, goodwill is not allocated to reporting units. It is allocated to cash-generating units, or CGUs.
Cash-generating units. How does it actually differ from a U.S. reporting unit?
A CGU is strictly defined as the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets.
Okay.
Conceptually, a CGU is often at a much lower, more granular operational level than a U.S. GAAP reporting unit. While they sometimes align in practice depending on the corporate structure, IFRS forces the impairment test down closer to the individual asset level.
So it's harder to aggregate and hide failures behind those massive cushions we just talked about.
Exactly. IFRS is stricter on the perimeter. But the real divergence, the part that completely changes the valuation models you build, is in the quantitative math of the test itself.
Right. Let's break that down.
Under US GAAP, the impairment test is relatively straightforward in its comparison. You compare the carrying amount of the reporting unit on the balance sheet to its fair value.
And fair value under U.S. rules is strictly an exit price concept, right?
Yes.
It is based on market participant assumptions. Basically, what would an independent, rational, third-party buyer pay for this business unit right now?
Exactly. But IFRS throws a major curveball here. Under IFRS, the test compares the carrying amount of the CGU not to fair value, but to its recoverable amount.
Recoverable amount, that sounds different.
That term is the absolute cornerstone of the IFRS impairment model. You have to understand how it is calculated. The recoverable amount is defined as the higher of two distinct metrics.
Okay, what's the first one?
The first metric is fair value less costs of disposal. And this is somewhat similar to the US GAAP fair value concept, assessing market value, though it explicitly deducts the costs you would incur to sell the unit.
Right, like broker fees or legal costs.
Exactly. But it is the second metric that changes everything. The second metric is called value in use.
Value in use. This is where it gets incredibly fascinating for valuation modeling. Because value in use is not what the open market thinks the asset is worth.
No, not at all.
It is an entity-specific measurement.
Yeah.
It relies on management's own internal expectations. It uses cash flow projections based entirely on how this specific entity intends to continue using the assets, rather than strict, observable, objective market participant assumptions.
Yes. It is an internally facing valuation because the recoverable amount under IFRS is the higher of fair value, less cost to sell, or a value in use. IFRS effectively gives corporate management 2 bites at the apple to defend the carrying value of their goodwill.
Wait, let me make sure I am grasping the real-world implication of this.
Sure.
If the broader economy is in a recession, industry multiples have absolutely crashed, and the objective market participant fair value of a business unit has plummeted way below its carrying amount.
Yes.
Management might still completely avoid taking an impairment charge under IFRS.
Absolutely. If they can build a discounted cash flow model that justifies a high value in use based on their own internal proprietary and perhaps overly optimistic operational turnaround plans, they use that higher number. As long as the value in use is higher than the carrying amount, there is no impairment, regardless of what the open market says the unit is worth.
That is a staggering difference. So if you are an analyst covering a massive multinational corporation that is cross-listed and reports under both frameworks,
Yes.
or if you are comparing a US telecom to a European telecom, you have to adjust your expectations.
Right.
A company could theoretically face a catastrophic multi-billion-dollar goodwill impairment charge under US GAAP because the objective market value dropped, but simultaneously report zero impairment under IFRS because their internal value and use calculation kept the recoverable amount artificially elevated.
Precisely. You cannot seamlessly port an impairment model from a U.S. competitor to an international one. You must adjust your forecasts based on the specific accounting framework governing the unit of account and the specific valuation mechanism, market exit price, versus internal value in use required by that framework.
That is crucial. Okay, let's transition into the actual timeline of this process. We know what we are testing, we know where we are testing it, and we understand the global rules of engagement. Now, when do we actually sound the alarm?
The timing.
Right. When does management sit down and do the math? Because the baseline rule is pretty standard across the board. Both US GAAP and IFRS require goodwill to be tested at least annually.
At least annually.
And they can't just pick a random date when the stock happens to be up. The company must select a consistent measurement date, say October 1st, every single year, and stick to it.
But if you are actively managing a portfolio, you cannot afford to just sit back, mark your calendar for October 1st, and wait for the annual 10K to drop.
Right. That's too slow.
Way too slow. The annual test is merely the minimum regulatory compliance requirement. If a triggering event occurs at any point during the fiscal year, an interim impairment test is absolutely mandatory.
Right. This is where the detective work comes in for us. Identifying these triggers in real time, months before the company officially announces them, is how a sharp analyst gets ahead of the market.
Exactly.
The accounting guidance defines a triggering event as any event or change in circumstances that would, more likely than not, reduce the fair value of a reporting unit below its carrying amount. So let's detail these specific triggers. Let's start with the big picture. Macroeconomic events.
The macro environment is the foundation of valuation. A severe economic downturn or a sudden recession is an obvious trigger. But more specifically, and more relevant to recent markets, is the impact of spiking interest rates.
Oh, yeah.
When central banks aggressively raise interest rates, the cost of debt across the economy increases. The risk-free rate, usually tied to government bond yields, shoots up. Consequently, the weighted average cost of capital, the WACC, for every reporting unit spikes.
And for anyone listening who builds DCF models, you know exactly what a higher WACC means. The WACC is the denominator in your present value calculation.
Yep.
When you apply a higher discount rate to the exact same projected future cash flows, the mathematical present value of that reporting unit violently compresses.
It shrinks instantly.
Even if the business is operating perfectly, a macro spike in rates can crush its fair value and trigger an impairment. Other macro triggers include restricted access to capital markets, or if credit markets seize up and the company can't refinance its debt.
Moving down from the macro level, you must evaluate industry and market considerations. Are we seeing a structural deterioration in the specific environment in which the reporting unit operates?
Like what?
This isn't just a bad quarter. This is a dramatic increase in the competitive landscape. Perhaps a well-funded rival just entered the space, forcing a brutal price war that destroys profit margins. Or perhaps there is a disruptive technological shift. If you acquired a cable television provider and the entire consumer market structurally shifts to streaming video, The legacy reporting unit's products are effectively obsolete. That is a triggering event. Massive regulatory changes that structurally impair profitability, like a new price cap on pharmaceuticals, also force an interim test.
And then there are the entity-specific triggers, which I feel like are often the most sudden and devastating.
Oh, absolutely.
A prime example is the loss of a key customer. The accounting guidance specifically highlights losing a customer or a revenue contract that represents 10% or more of the reporting unit's total revenue.
That's a huge hit.
It's an immediate catastrophic hit to projected cash flows. The goodwill premium was based on keeping that customer. If they leave, the premium is impaired.
Another entity-specific trigger, especially prevalent in the technology and pharmaceutical sectors, is a mass exodus of key personnel.
The talent walks out the door.
Exactly. Consider an acqui-hire scenario. A legacy firm pays a massive premium to acquire a cutting-edge artificial intelligence startup, almost entirely to secure its brilliant engineering team.
Okay.
If, 6 months after the acquisition closes, the vesting periods expire and the entire core engineering team resigns to start a new company.
Which happens all the time in Silicon Valley.
All the time. The primary driver of that goodwill has just walked out the door. The physical laptops they left behind aren't worth the premium. That is an undeniable triggering event. Similarly, if management announces a strategic pivot, say they decide to discontinue the flagship product line they just acquired, the historical cash flow projections used to justify the original premium are completely voided.
But out of all of these, the most visible, undeniable trigger, and the one that short sellers and analysts track most aggressively, is related to the overall market capitalization of the entity.
Oh, yes, the big one.
A sustained drop in the stock price where the market capitalization falls below the book value of the company's equity is a screaming siren.
It is the ultimate reality check.
I really want you, the listener, to grasp the power of this metric. If you are watching a volatile market and a company's market cap falls below its book value, that is a glaring public trigger that absolutely no controller, CFO, or external auditor can ignore.
None of them.
It completely forces management's hand. Management can sit in a boardroom and debate internal cash flow projections, synergy timelines, and value in use all day long. But they cannot debate the publicly traded stock price blinking on the terminal.
Exactly.
If the collective wisdom of the stock market is saying that the entire consolidated company is worth less than the net accounting asset sitting on the balance sheet, there is almost certainly a massive impairment hiding inside one of those reporting units.
And I assure you, the auditors will weaponize that exact logic. During the interim review, the audit partner will look at the consolidated market cap and demand a rigorous reconciliation.
Oh, to be a fly on the wall in that meeting.
Right. They will sit across from the CFO and say, you claim the fair value of reporting unit A is $2 billion and reporting unit B is $3 billion based on your internal models, but the total public market cap of your entire company is only $3.5 billion. Explain the $1.5 billion delta.
Ouch. I mean, how does a CFO even respond to that?
They try to argue that the public market is acting irrationally or that there is a temporary liquidity discount.
Naturally.
But the auditors rarely accept that for long. Usually, the only way to reconcile that gap is for management to admit that one of those reporting units is severely overvalued internally and requires an immediate goodwill write-down to reconcile the balance sheet with market reality.
That brings us to the actual mechanics of the impairment test. The triggers have been pulled, the auditors are in the room. What happens next? This brings us to step 0, the qualitative filter, or, as I like to refer to it, checking the weather before you decide to spend a fortune building the whole valuation model. Step 0 is technically an optional qualitative assessment introduced by the accounting boards to save companies significant time, internal resources, and exorbitant external audit fees.
The entire premise of step 0 is efficiency. Instead of immediately hiring a third-party valuation firm to build a massive, complex, discounted cash flow model from scratch, a company can first evaluate qualitative factors.
Makes sense.
The goal is to determine if it is more likely than not that the fair value of the reporting unit is less than its carrying amount. In strict accounting terminology, more likely than not is defined as a greater than 50% probability.
To make this determination, management looks at the totality of the triggering events we just discussed. They write a detailed memo assessing macro conditions, rising material costs, overall financial performance, and changes in executive leadership.
Right.
But the single most critical concept in step 0, the defense that management leans on the hardest, is the idea of the cushion.
The cushion is the absolute cornerstone of the qualitative defense. To establish the cushion, management looks backward at the most recent prior quantitative valuation.
Let's walk through the math on that.
Suppose last year, the company performed a full, rigorous DCF analysis, and the fair value of the reporting unit was determined to be $100 million. The carrying value of the net assets on the balance sheet was only $60 million. That $40 million gap, the excess of fair value over carrying value, is the cushion.
So if that historical cushion is massive, say the fair value was almost double the carrying value, and the macroeconomic changes over the last 12 months have been relatively minor, the company feels safe.
Very safe.
The controller writes a qualitative memo stating that despite a slight uptick in interest rates or a minor dip in quarterly revenue, that $40 million cushion is more than sufficient to absorb any hypothetical decline in value. Therefore, they conclude it is not more likely than not that the fair value has dropped all the way below $60 million. They pass step 0, the auditor signs off on the memo, and they stop testing entirely. No complex math required.
That is how it works in theory. However, there is a very real strategic decision every CFO and controller must make here.
What's that?
When should you skip this optional step 0 entirely and go straight to the hard quantitative math? The reality on the ground is that many companies, often pressured by their auditors, choose to bypass step 0 intentionally.
Wait, really? If it's designed to save time and money, why would they volunteer to do the complex math? That sounds completely counterintuitive.
Because of regulatory scrutiny, the Public Company Accounting Oversight Board, the PCAOB, heavily scrutinizes auditor documentation. If the historical cushion is very thin, say, last year the fair value was $65 million and the carrying value was $60 million, that is only an 8% cushion. It becomes incredibly difficult to qualitatively prove in a memo that a slight increase in inflation, a minor supply chain disruption, or a competitor's new product didn't wipe out that thin $5 million buffer.
I see. The amount of time, energy, and robust documentation required to defend a razor-thin cushion to a highly skeptical, risk-averse audit partner takes almost as much effort as just building the DCF model in the first place.
Exactly.
You paying for the audit hours, either way, just arguing over qualitative adjectives, so you might as well just do the quantitative math and remove the ambiguity.
Precisely. The qualitative memo becomes a magnet for regulatory challenge, and for newly acquired reporting units that haven't had time to build up a cushion, or for units operating in highly volatile industries like crypto or biotech, step 0 is rarely sufficient. To ensure compliance and avoid PCAOB deficiencies, firms simply default to the quantitative test.
Which perfectly transitions us into the math itself. If a company fails step 0, or if they wisely choose to skip it, we execute step 1.
Step 1.
The core math of step 1 is simple in concept, but incredibly complex in execution. Compare the fair value of the reporting unit to its carrying amount, which includes the goodwill.
Determining that fair value is where the heavy analytical lifting occurs. The accounting standard ASC 820 outlines 3 valuation methodologies. First is the income approach, which is overwhelmingly the most common primary method.
Right.
This relies on the discounted cash flow, or DCF model. Analysts and valuation experts project the free cash flows of the reporting unit over a discrete period, usually 5 to 10 years, calculate a terminal value to represent cash flows into perpetuity, and discount it all back to present value using the reporting unit's unique WACC.
Second is the market approach. This utilizes EBITDA multiples or revenue multiples derived from guideline public companies, basically publicly traded peers or precedent transactions involving similar companies in the exact same industry.
It's a great sanity check.
Right. It provides a vital, market-observable reality check on the DCF. If your DCF says the unit is worth 20 times EBITDA, but every public peer is trading at 8 times EBITDA, your DCF assumptions are probably wildly optimistic.
To say the least.
And finally, there is the asset approach, which involves valuing individual underlying assets and liabilities, though this is rarely used as the primary method for a going concern operating business. Often, valuation professionals will use a weighted combination of the income and market approaches to triangulate the fairest, most defensible estimate.
Now, to truly appreciate how streamlined the current rules are, we have to look back at the legacy nightmare that was the old US GAAP Goodwill Impairment test.
Oh, the old rules.
Prior to the 2017 FASB simplification known as Accounting Standards Update 2017-04, the impairment test was a brutal 2-step process. If a reporting unit failed step 1, meaning its carrying amount exceeded its estimated fair value, the company could not simply record that difference as the impairment loss.
No, they had to do step 2.
They were legally forced to perform what was known as step 2.
And step 2 was widely despised by literally everyone in the financial reporting ecosystem. Controllers, auditors, analysts alike.
Everyone hated it.
To calculate the impairment amount under the old step 2, a company had to hypothetically revalue every single individual asset and liability within the reporting unit as if they were acquiring the business today. They had to do a brand new hypothetical purchase price allocation from scratch.
It was an agonizing exercise in fiction.
Exactly. They had to assign current fair value to the desks, the office chairs, the legacy software licenses, and even try to value unrecorded intangible assets that weren't even on the balance sheet, just to calculate the implied fair value of goodwill.
It was phenomenally expensive and highly theoretical. You were paying valuation experts hundreds of thousands of dollars to construct a completely hypothetical acquisition scenario solely to figure out the residual plug.
So inefficient.
The FASB finally recognized that the massive cost and complexity of Step 2 vastly outweighed any marginal informational benefit provided to financial statement users. Investors didn't care about the hypothetical fair value of office chairs. They just wanted to know how much value was destroyed.
So under the new simplified reality created by the FASB update, Step 2 is dead.
Dead and buried.
It is entirely eliminated from US GAAP. The impairment test is now a single-step calculation. The impairment loss is simply the exact amount by which the carrying amount of the reporting unit exceeds its fair value. It is clean, it is direct, and it drastically accelerates the financial reporting timeline during earnings season.
However, there is a critical cap to this single-step calculation that you must ensure your models reflect.
Right, the cap.
The impairment loss recognized can never, under any circumstances, exceed the total carrying amount of goodwill allocated to that specific reporting unit.
Let me clarify this with some numbers so the listener can visualize the journal entry. Imagine we have a reporting unit. The carrying amount of the entire unit on the balance sheet is $50 million. We run our DCF and our market approaches, we weigh the results, and we determine the true fair value of the unit is only $30 million.
Okay.
That is a $20 million shortfall. But let's say we only have $10 million of goodwill allocated to this unit on the balance sheet. We don't take a $20 million hit to goodwill, right?
Correct. You cannot create negative goodwill. The impairment is strictly capped at the total amount of goodwill present. In your example, the impairment loss would be exactly $10 million, wiping the goodwill balance for that unit down to zero.
But wait, what about the remaining $10 million of the shortfall? Where does that go?
That is the crucial question. The remaining $10 million shortfall implies that other long-lived assets within the unit, like the PP&E or the finite intangibles, might be impaired. Which is exactly why the hierarchy of testing we discussed at the very beginning is so vital. If management followed the strict order of operations correctly, those other assets should have already been written down before goodwill was ever tested.
And if they weren't?
If they weren't written down and you hit the goodwill cap with a massive shortfall left over, the auditors are going to halt the process. They're going to have serious, uncomfortable questions about the validity of your initial ASC 360 PP&E impairment tests. It means you miss something fundamental.
That is a phenomenal connection back to the hierarchy. Everything in accounting is interconnected. Okay, let's look at the actual aftermath of the test. When the math is done, the shortfall is calculated, and the cap is applied, somebody has to actually book the entry. Let's walk through the accounting mechanics and the tax realities.
The journal entry itself is mechanically straightforward, but fundamentally devastating to the financial profile of the company. You debit goodwill impairment loss, and you credit goodwill.
The debit to goodwill impairment loss flows directly to the income statement. It sits in operating expenses, usually broken out as a separate, highly visible line item if it's material.
Very visible.
Because it hits operating expenses, it immediately shrinks operating income, it crushes EBIT, and it flows all the way down to shrink pre-tax income. The credit, conversely, hits the balance sheet. It directly reduces the intangible asset of goodwill, which in turn shrinks total assets and proportionally reduces shareholder equity.
And we must emphasize the no backsies rule. This is critical for forecasting. Under both US GAAP and IFRS, once goodwill is written down and impaired, it can never be reversed. This represents a permanent destruction of recognized value.
So if a company takes a massive impairment charge during a deep recession in 2023, but by 2025, the macro environment completely pivots, interest rates drop back to zero, the reporting unit secures massive new government contracts, and the fair value skyrockets far beyond its original carrying amount, they still can't write the goodwill back up.
Absolutely not. That impaired goodwill is gone forever. You cannot write it back up. The accounting standards treat goodwill impairment as a realization of a permanent loss of the original acquisition premium. The newly generated value is internally generated goodwill, which accounting rules strictly prohibit from being recognized on the balance sheet.
That permanence is staggering, and it leads directly into what makes the tax realities of goodwill impairment so shocking, particularly for junior analysts or newly minted controllers.
Boy, tax shock.
Right, because when you see a massive expense hit the income statement, say a $200 million impairment loss, your natural instinct as an analyst is to assume it creates a tax shield.
It's logical.
You assume it will lower your taxable income and save you cash on your actual tax bill, softening the blow. But goodwill impairment often blindsides people because in most standard corporate acquisitions, it is generally not tax deductible.
The disconnect arises because of the fundamental difference between book accounting and tax accounting. Book goodwill, the amount recorded for financial reporting under purchase accounting that we've been discussing, is entirely separate from tax goodwill.
The IRS does not care about your GAAP fair value models.
They really don't. The deductibility of the impairment hinges entirely on how the original M&A transaction was legally and fiscally structured years ago.
Exactly. Let's break this down. If the original deal was structured as a standard stock acquisition, which many large public deals are, the acquiring company simply bought the equity shares of the target.
Right.
For tax purposes, the basis of the underlying assets inside the target company does not step up to fair value. Therefore, no tax-deductible goodwill is ever created. So 5 years later, when you take a massive $200 million book impairment charge to write down that stock deal goodwill, it generates absolutely no tax deduction. It creates no deferred tax asset. It offers zero tax shield. It is pure, unmitigated pain on the net income line. Your net income drops by $200 million, but your cash taxes paid to the government do not decrease by a single cent.
The only scenario where goodwill impairment interacts with taxes in a beneficial way is if the original transaction was structured as an asset acquisition, or if an election was made under Section 338 of the tax code to legally treat a stock sale as an asset sale for tax purposes.
Okay, what happens then?
In an asset acquisition, the buyer gets a stepped-up tax basis in the assets, and goodwill is actually created for tax purposes. This tax goodwill is typically amortized on a straight-line basis over 15 years for tax deductions. If you later impair the book goodwill that corresponds to this tax-deductible goodwill, there are highly complex deferred tax implications, but at least there is an underlying tax basis providing some eventual shelter.
But as we noted, for the vast majority of standard corporate stock deals, an impairment charge is a permanent, non-deductible hit to earnings. If you are building a model and you project a goodwill impairment, but you incorrectly apply the corporate tax rate of 21% to that loss, you will materially overstate the company's projected cash flows and net income. You will be wrong, and your valuation will be wrong. Always check the deal structure of the legacy acquisitions in the footnotes.
That is a phenomenal piece of practical advice.
Let's move to our final primacy topic. Everything we have discussed so far, the hierarchy, the reporting units, the interim triggers, the complex math, applies to public entities. But the FASB eventually recognized that the exorbitant cost and complexity of this annual impairment testing regime was disproportionately crushing private companies.
It was a massive burden. To address this, the Private Company Council, or PCC, developed an accounting alternative specifically for private companies and nonprofits. Under this alternative, a private company can elect to amortize goodwill on a straight-line basis over a period of 10 years, or potentially less if they can rigorously justify a shorter useful life.
That is a fundamental divergence from public company GAAP. Under public rules, goodwill is an indefinite-lived asset. It just sits there unamortized until it fails an impairment test. But by amortizing it, private companies steadily, mechanically reduce the carrying value of their goodwill every single month.
Right.
This systematically shrinks the balance sheet, yes, but it also systematically shrinks the likelihood of a future massive impairment charge. Because the carrying value is constantly dropping, it rarely exceeds the fair value.
Furthermore, private companies electing this PCC alternative are granted a massive compliance reprieve. They are exempt from the mandatory annual impairment test.
Wow, really?
Yep. They only have to perform an impairment test if a triggering event occurs. And recently, the FASB provided even more relief. Private companies can now elect to evaluate these triggering events only as of the end of their reporting period, whether that is annual or interim. They no longer have to continuously daily monitor the macro environment for triggers like public companies do. This saves immense amounts of management time and external audit fees.
But here is the critical warning for the listener, and this is what we call the SPAC or IPO trap. This is absolutely vital for any analyst working in private equity, venture capital, or evaluating pre-IPO S1 filings. Let's play out a scenario.
Okay.
You are looking at a highly successful private tech company. They have been aggressively acquiring smaller competitors and have been using this PCC alternative for 5 years. They have been happily amortizing their goodwill, shrinking the balance, and ignoring mid-year triggering events.
Sounds great for them.
Now, the market is hot, and they decide to go public via a massive IPO, or they merge with a public special purpose acquisition company.
The moment that private company formally meets the SEC definition of a public business entity, or PBE, the rules of the game completely change. Public companies are strictly prohibited from using the PCC alternatives.
They can't use it anymore.
No. Therefore, the company must reverse all private company accounting alternatives in its historical financial statements to make them fully compliant with public company GAAP for the S1 registration statement.
Think about what that actually means operationally. They have to go back in time to the exact date they first adopted the alternative. They have to painstakingly reverse 5 years of amortization expense.
Which is tedious.
That alone completely changes their historical net income trajectory, making past years look vastly different than what private investors were told. But reversing the amortization is just basic math. The real nightmare is the impairment testing.
Exactly. Because they are now required to apply public company GAAP retrospectively across all those historical years, they must evaluate whether interim triggering events occurred during any of those prior historical periods.
Oh, no.
And here's the kicker. They have to do it without the use of hindsight. If an interest rate spike or a lost contract occurred 3 years ago in Q2, they have to reconstruct a complete fair value calculation for that specific reporting unit as of that specific historical date, based only on the information and projections that were known at that exact time.
It is a costly, complex, highly scrutinized forensic audit nightmare. You are essentially paying armies of valuation experts to rebuild historical alternative realities. If you are an analyst modeling an IPO or a SPAC merger, you need to aggressively factor this in to your timelines and risk assessments.
Definitely.
If a private company is carrying heavy goodwill and has been utilizing the PCC alternative, the transition to public company GAAP is going to unearth major volatility in their restated historical earnings. And more importantly, it can potentially trigger massive historical impairment charges that were previously hidden by the private company amortization rules.
It is a critical due diligence item that is often overlooked until the last minute. The sheer cost and complexity of unwinding the private company alternative can sometimes delay an IPO timeline by months, completely missing the optimal market window.
So as we wrap up this deep dive, let's summarize the core thesis. Goodwill impairment is not just a non-cash accounting entry that lazy analysts should reflexively add back to EBITDA and ignore.
No, absolutely not.
It is a permanent historical adjustment to a management team's capital allocation record. It is the financial system demanding rigorous accountability for M&A premiums. Mastering this concept requires a deep understanding of the strict hierarchy of testing, the specific perimeter of the reporting unit, the profound nuances between US GAAP's fair value and IFRS's value in use, a sharp eye for macroeconomic and entity-specific triggers, and a clear grasp of the painful, non-deductible tax realities of the write-downs.
And beyond the rules, it requires treating the balance sheet as a dynamic, deeply interconnected system. An impairment in fast fashion inventory or uncollected receivables today is the leading indicator, the canary in the coal mine, for a catastrophic goodwill impairment tomorrow.
I want to leave you with a final forward-looking provocative thought. You need to apply this to the market right now. We have spent the last few years aggressively transitioning from an unprecedented era of zero interest rates into an environment where central banks are holding rates higher for longer.
The paradigm shift.
Exactly. When interest rates were zero, capital was essentially free, hurdle rates were rock bottom, and management teams were heavily incentivized to pay massive, unjustifiable premiums for acquisitions. The weighted average cost of capital in their internal DCF models was incredibly low, which artificially inflated the present value of future cash flows and allowed auditors to sign off on those massive goodwill balances.
But the fundamental math of the economy has changed. With today's much higher risk-free rates, the WACC in those exact same corporate DCF models naturally goes up, and mathematically, when the discount rate goes up, the present value of those future cash flows, the fair value of the reporting units, comes down dramatically.
So look at your coverage universe tomorrow morning. Look closely at the companies that made aggressive premium acquisitions during the zero interest rate exuberance of 2020 and 2021. With today's higher WACC fundamentally compressing their fair value, how many of those reporting units have completely burned through their historical qualitative cushions? How many are sitting on paper-thin margins of error? Just one minor triggering event, one missed quarterly earnings target, one delayed product launch, one lost customer away from a permanent non-tax deductible impairment charge that will wipe out billions in equity. The dominoes are lined up. It's just a matter of which trigger falls first. Thank you for joining us for this session of Talk Tickers.